All right, ladies and gentlemen, I hope you had a wonderful day. It was quite the interesting start to the week. We ended up gapping down and then moving up throughout the day, but there was everything from election volatility in France down to the Apple event, and then with all of the big events we are having this week, the question of oil risk premium keeps coming up. So we're going to talk about that. That's actually one of the main questions that I got today on stream. We're going to go over that, go over what happened today, the other things we got to watch out for the rest of the week, because it still is a huge week for data, the Fed, and all of that. And then we got to go over the plays and then an economic lesson. So Chad, what I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stock Market. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then it feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, before we get into the data, before we get talking about oil, I have to bring this up because it is so important. And the last time we saw anything similar last week, I was also freaking out. So we get the data on Wednesday, CPI in the morning, and then Jerome Powell and the summary of economic projections, aka the dot plot. That is what we are waiting for on Wednesday. Tomorrow you will be getting a 10-year bond auction. That's probably going to be the most important event. But once again, we started off this week with elections around the world making waves and increasing global market volatility. Believe it or not, you had the pound hit a level it hasn't done in a while, and I was just talking about this. Lately, all you've heard about is the dollar and the yen. Every other currency has pretty much behaved pretty good ever since everybody was expecting rate cuts. But once again, these elections last week, it was Mexico and India. That started upsetting the currencies. It started affecting the countries, and now this morning there was a big loss by Macron in France, and he called the snap election and say, well, y'all don't like me, then let's vote on it right now. And pretty much it started causing the pound to move, and other places people are starting to get worried that a lot of these election moves are causing volatility. So yes, we're going to have a big data week, but with everything heating up over the next 6 months, don't forget, our election is probably the most important. I know I'm American, we like to say that, but clearly, these elections around the world are causing a lot of shakeups, and this is something that you should not ignore. So that was a big factor of what we got today. That's what really started us off lower. We were able to melt up, and then even after Euro close, we kept going, but definitely keep your eyes out for this. So that is key number one. Also, don't forget you have that bond auction tomorrow, but now key number two, we get the CPI on Wednesday. I don't think the data tomorrow, besides the bond auction, should move us. The data after the bell leading into Wednesday morning, that's going to be China data and some other Great Britain stuff. That will probably move us more, but then within a couple of hours, you will get the US CPI. But here's the deal. People are actually worried about the CPI. JP Morgan came out and they said that the CPI is going to cause a stock market shock. Other people are raising their expectations for what they think is going to happen with CPI. And I hate to break it to you, even the SEP right now, analysts and economists are debating on whether or not the SEP is going to show one cut or two cuts. But why that's such a big surprise? Because lately we've been pricing in 3 cuts. Ever since the end of last year, we've been pricing in 3 cuts. Even at March, we had the opportunity to get away from that. Nope, we stayed at 3 cuts, but now people are thinking that's going to move, and right now it's priced in that it would be more of a hawkish move rather than a dovish move. So what this means for you tomorrow, watch if any of these estimates start changing as we get ahead of the event. Tomorrow will be the last day to kind of position, and let's see where everybody is at ahead of it. But for the most part, everybody is getting worried a little bit, and they don't want to go down, but in a weird way, everybody is bracing for impact. And just like the other times, I think around March, if that doesn't happen, then you are going to get your green light into the rest of summer. But now, with all these expectations moving around, with you getting the CPI first and then Powell, it is going to be very wild to trade. And now this is the other weird part about it, is because whatever happens with the CPI, it can cause a big reaction, but until Powell speaks, you're not going to be able to get the full scope of all of it. So I think this is going to be a very difficult one to trade. Today was already a weird day in the markets, but both ahead of the event and after, I think it's going to be a little weird, especially if the data and the stuff we get is not as clear cut. But remember, if things don't change much from how they have been, the market would prefer that more so than not. Yes, we want to see progress, but as long as we don't degress, the market has found a way to take that positively. So watch out for that. That is key number 2. And then finally, I wouldn't shut up about this today. I brought it up on the watch list yesterday, but yes, this data is going to be important. It's going to lead us for the next couple of months. But what you got to really understand right now is that the steepening of the yield curve, or the lack thereof, and how we move forward over this next couple of months leading into the hike and the election, the main question is, do we get a hard landing and do those odds reemerge from the ashes, or do we stick to the current plan of soft landing, and does that hold through towards the end of the year? And people ask, what does that mean, soft landing? How do you know that you get it? It would mean that inflation has came down without the economy deteriorating. Maybe that means lower rates. Maybe the rates are at the same place, but the general idea, inflation stops going up, inflation comes into control and back to some of the targets, while at the same time not sacrificing an economic pullback or having one. So that's the main key. It is a little early now. We're just in June, but we have been talking about this for like 7 or 8 months now. That's why it's so important, because after this month, pretty much towards the end of summer, we will be entering crunch time. It's hard to say if we're in fourth quarter. I don't think we are, but we're definitely wound down a lot of clock. You only have a couple more data sets left on the end of the year, and as we start getting closer to the election, there should be a plan that's more outlined. But like I'm saying, every month that goes by, if the story doesn't start to change, it's either we got to confirm one or the other, and then we only have such little time to start making the final move. So keep this in mind. Watch out for the curve to steepen, aka the yield curve uninverting, and the hard landing, soft landing odds as those fluctuate. That is what will contribute to a steepening or further inversion of the curve, or keeping it where it's at now. So hopefully you watch out for that. Hopefully you're ready for all of it. But now let us get into the plays. So right off the bat, I did not make that many moves today, but I'm going to start with the one I wanted to make a play on. But my problem is this stock has already been up a lot, not only on the year, but even in the last couple of weeks. This thing has been an outperformer. It's been running up, so it's hard to tell whether or not this is priced in. But Eli Lilly, they had big Alzheimer news. The FDA voted 11-0 that one of their drugs can help with Alzheimer's. I don't know if it's the Ozempic GLP-1 stuff. Remember, they have a lot, and that's what's going to make all the sympathies a little bit difficult. But they were saying that this can be used, or that there's some drug that they have that can be applied for Alzheimer's. They still need to work out its safety things and vote on that, but this is huge news. Up until this, the only real drug in Alzheimer's that had any sort of progress with the FDA, it was Biogen, and as that fluctuated back and forth, you've seen how that stock has moved. So this is big. The only problem I have, stock is already up a lot, and we need to see what they say about the safety and efficacy. But if this starts to turn into beyond just the Ozempic play, and you start getting Alzheimer news, I'm telling you, this is a huge unmet need in the biotech world, and this could be absolutely massive. So watch out for that. The other thing, be careful of the sympathies and watch if they get similar approvals. It's very easy to look at Eli Lilly and then go for NVO and all these other names, but like I'm telling you, this Alzheimer news does not just happen. Yes, it could be good for a sympathy, but until they get an approval, the only real winner is Eli Lilly. So watch out for that. That is play number 1. Then play number 2. This one I thought was very interesting. Some people like it, some people don't. Some people get mad. I don't know. Welcome to 24. But DJT, man, Donald, or at least it was the company, but I'm saying it was Donald. But the company filed an updated SC or S1 registration statement saying they are registering to sell the securities by certain shareholders, and they even mentioned Donald Trump. So all of that money homeboy got, and now the lockup and all of that, well, he is now good to go to start selling, or I believe in a couple of weeks here. So this is going to be very interesting because, once again, all these different events have happened with Donald Trump, and everybody has been expecting certain reactions. Let's see what this does now, as this could add a lot of supply to the stock, but we will see. Are people going to respond to supply or demand, or does this turn into kind of an election wave hype play, kind of detached from any of the fundamentals? Let's see what happens. But that is play number 2. And then finally, Apple. This was wild. I kind of want to make a play on it, but we got to watch out for the CPI effect. And what I mean by that, does the CPI and the data and Powell, does it kind of help whatever Apple does or not? But they had their WWDC conference today, and it was like the 4th, I believe, or 2nd worst day of any Apple event. It was like 1.9%. Doesn't seem that big, but Apple, 2% on a stock that big is kind of large. So at any of the other events, they haven't really moved like this. But in my opinion, it was very underwhelming. Apple was trying to hijack the word AI and call it Apple Intelligence. They announced the partnership with GPT and all of these features that they were going to do with it, an update to Siri and how it could be used with AI. But for a company where everybody's like, oh, they're falling behind, they need to do this, and you see how crazy the world is going over AI. I mean, it just looks to be Microsoft, NVIDIA, ChatGPT. Those just seem to be the leader, and everybody else is still kind of lagging behind. So watch for a follow-up effect, especially after the data, but this could be very big, especially if analysts feel the way that I do. If everybody kind of feels this was underwhelming, we saw what's happened to Google before at some of those. They didn't have any mess ups, so that's the good part, but we'll see if it's going to garner optimism while the other guy is just hitting 3 trillion nonstop. So we'll see what happens, but those are the main plays. As far as everything else, I did not make any plays today, so we're still chilling. Again, everything from yesterday, that all applies till today. I outlined all the plays. The only one I didn't mention, I'm still in that gold play. A micro gold contract, I think it's down like $300. We were up like 400 or 500, and then it flipped after that Friday. Even though we had the data, there was that news of China not buying gold for the last like month or so. But other than that, still in the same plays, going to be riding them out. And now into the questions. This has to do with the oil risk premium. And sadly, I told you guys about this yesterday. Oil was already up a little bit. I thought it was going to kind of chill out, maybe have a pullback. Nope, it went ape right off the morning and ended up closing up 3%. It didn't do anything like that last week, even though it sold off very big. But in talking about this, we brought this up and people were asking me, why is oil a geopolitical hedge and how is it cheap right now? So to answer the first question, oil is a geopolitical hedge because usually oil goes up when there is geopolitical events. When something bad happens around the world and there's geopolitical tensions, you have wars, conflict, wars, usually oil is the first thing that is going up. If you own it and something bad happens, it goes up in value. So if your whole portfolio goes down and you have oil, you may lose in one area and then make money in the other. That is why it is a hedge. And now what makes it cheap right now is because usually when bond yields are high globally, that's usually indicating more risky of an environment, and even gold is rallying and other assets too, like copper and aluminum and all the other commodities. When they're usually going up and doing so rapidly, that's kind of indicating something bad is happening, or just like the high rates show, it is less favorable. So right now, the fact that gold is ripping through the roof and that yields are the highest they've been in years, and some of the other commodities are also running up, but now you have oil not being as high and staying within the range it's been in over the last couple of years, this is showing that the risk premium is not priced in. So this was the chart that I showed yesterday, and it's just showing you oil versus gold throughout the last 40 years or so. And the last time we've been at this level right now, I don't know how it factors in after the 3% move. This was from Friday, but the fact that it was already trading low with gold and everything else up, last time it was around here, it was like 2019 leading into COVID, and then 2014 through 2017, this was the first time you had that Russian-Ukraine stuff, and then we had all of the oil, and then what was it, the fracking? You guys remember all of I don't know, some of you may not remember, but the point was that was like oil was going through a ton, and oil even went from 100 all the way down to like 40 and a little bit lower at the time. But then you start going back even more, it never was even this cheap leading into 08 or 09, even 1999, it was kind of where it was at now, but it doesn't usually happen like this. This is actually super important, and this is why I'm bringing it up, and I'm glad you guys asked questions about it, because you got to think logically about it. Like, yields are high. People are saying something is happening, something is risky, gold is going up, silver is going up. Yes, you probably know the reason why, because of the election, but even then, it doesn't matter. Why is oil trading so cheap? Whether you want to answer the why or not, the fact of the matter is, historically now, this is showing you a cheaper price. And relative now, if you think there's going to be risks around the world or more geopolitical tensions before or after the election, this is one of your cheapest plays pound for pound. And the best part that people are talking and touting about it is that if nothing happens, even if you buy it, it could be a hedge, but it's already cheap. It's already back within its range. Worst case scenario, it just trades within its range. Maybe you buy it at 70s, high 70s. It goes lower, as low as like $60, maybe the high 50s. People aren't really expecting that to change too much. So that is what has been driving a lot of people to it. So keep your eyes out for this. I did not get in, so I'm telling you all this. I don't even have a position, but that's kind of the beauty, oil and everything going on. It may rip and never come back, or I wouldn't doubt it. That's one standard deviation now. If anything plays out, depending on what they do ahead of the election, maybe we see this thing come down even more, and then we could get a double dip. But definitely from now till the end of the year, this idea is something I'm going to keep in mind as long as oil is relatively cheaper to those other assets that could be saying there is risk. So hopefully that helps. But now, time for the lesson, ladies and gentlemen. We are still into the, state-centered approach. I hope it made sense from the last one. We were looking at society-centered, but now what happens when it is focused around the state and government, where they determine all of the actions. So we're going to get into that, but before we do, I think it's about time now. I got to start giving you guys some quiz questions, as these topics may come up, and I want to make sure you know them. So now that we've gone this far, this is from last chapter. My question for you, my brother: what is the factor model? What is the sector model? What are the strengths and weaknesses? Who uses them? Who doesn't use them? And then the final question, this is going to come up when we start getting into balance of payments and all of those things about actual trade and monitoring it. You'll see even then, we could even use trading economics a lot more powerfully after some of these lessons, but you need to know the answer to this question. What is import competing and what is export competing? Who usually gets the protection and why? So those are your questions there you got to be thinking about. Hopefully that means you are actually learning. But now, getting into the lesson, the state-centered approach. We are on states and industrial policy. A state-centered approach is based on two central assumptions, both of which contrast sharply with assumptions embodied in the society-centered approach. The first assumption concerns the impact of protectionism on aggregate social welfare. The society-centered approach argues that protectionism reduces social welfare by depriving society of the gains from trade and by employing society's resources in comparatively disadvantaged industries. But the state-centered approach argues that under certain circumstances, trade production can raise social welfare. So before I continue, take note. It's telling you what we just learned. If you're still not understanding, again, these comparisons and what one person supports, what one doesn't, the assumptions, those are the most important thing to the model. So hopefully you're picking up on that as we move along, just in case you start slipping up a little bit. But continuing, the second assumption concerns whether governments can operate independently of interest group pressures. The society-centered approach argues that national policy reflects the balance of power among competing interest groups, but the state-centered approach argues that under specific circumstances, governments are relatively unconstrained by interest group demands. As a consequence, a government's trade and economic policies embody the goals of national policymakers rather than the demands of domestic interest groups. The state-centered approach combines these two assumptions to suggest that under a specific set of circumstances, governments will intervene in the domestic economy with tariffs, production subsidies, and other policy instruments in ways that raise aggregate social welfare. To fully understand this approach, we need to understand the conditions under which such intervention may raise social welfare. We then can examine the institutional characteristics that enable national policymakers to act autonomously from interest groups to capture those welfare gains. So, before we get into the infant industry case, I want you guys to realize how this differs, but now think about it. When we are reading some of these, I'm sure some of you are like, oh, society-centered, oh, interest groups, lobbying, oh, we see it, oh, that makes a lot of sense, but dude, you live in America. Like, you got to really think about it, and as we've developed, it's not like we've always been at that, and at some times we have seen a more state-centered approach, but what I'm really saying is that everywhere around the world, and as we combine, this is why this model, this state-centered approach, you notice it's going against every other thing we just learned, and that's why sometimes you're like, oh, I like that. Oh, I think that's what we're living through, but remember, there's a weird hybrid of everything that occurs, but also, too, what we do in one part of the world may be very different than how it operates in another part of the world. So hopefully that makes sense. But moving forward, the infant industry case for protection. The economic justification for the state-centered approach rests on the claim that targeted government intervention can increase aggregate social welfare. This claim stands in stark contrast to the conclusions drawn from the standard model of trade that we examined in Chapter 3 and extend into our discussions of the domestic adjustments to trade in Chapter 4. The standard model rules out such welfare-increasing government intervention by assumption. In the standard model, society does best by removing all forms of trade protection and by specializing in its comparatively advantaged industry. Maintaining protection merely deprives society of the welfare gains from trade. Moreover, in the standard trade model, nothing makes it difficult for factors currently employed in comparatively disadvantaged industries to move into the comparatively advantaged sector. Factors of production will move into comparatively advantaged industries because it is profitable to do so. The returns in these industries are higher than the returns in the comparatively disadvantaged industries. Such movement will take time, there will be adjustment cost, and there is a case to be made for government policies that help individuals manage these costs, but such policies are oriented towards shifting workers and resources into sectors where they would go anyway. In this model, tariffs and any other form of protection can only make society worse off by preventing factors from moving out of low return and into high return industries. In the world depicted by the standard trade model, therefore, government intervention cannot raise social welfare. So again, he's just giving you the comparison of how it doesn't, this model does not stack up or has been ruled out by the other models we have discussed through Chapter 3 and 4. So in order to claim that a tariff and other forms of government intervention raise social welfare, one must be able to demonstrate that something prevent factors from shifting into industries that yield higher returns than are available in other sectors of the economy. Historically, the justification has been provided by the infant industry case for protection. The infant industry case for protection argues that there are cases in which newly created firms, infants so to speak, will not be efficient initially, but could be efficient in the long run if they are given time to mature. This is literally like all of your tech companies. Shout out SoftBank. Consequently, a short period of tariff protection will enable these industries to become efficient and begin to export. Once this point has been reached, the tariff can be removed. The long-run welfare gains created by the now established industry will be greater than the short-run losses of social welfare imposed by the tariff. So hopefully you're getting that. They're saying, yeah, well, a lot of models say that when you add tariffs and protectionism, it's hard to increase social welfare because you are limiting trade. But they're like, well, what happens if you can create a desalination, cure cancer plant, kind of like penny stock vibes, right? But then they're saying, well, if you protect that industry until it gets bigger, maybe a more realistic example, think AI in the United States. We protect it until it's able to take off on its own. Then we could just remove the tariffs and then the social benefits will come. That's kind of what this is saying here with the infant industry case for protection. So continuing, There are two reasons why an industry may not be efficient in the short run, but could be efficient in the long run. Economies of scale and economies of experience. Economies of scale arise when the cost of production varies with the size of output. That is, when the unit cost of producing falls as the number of units produced rises. For example, it is quite costly to develop a new commercial aircraft. Estimates put the cost of developing Boeing's new 777, no, it stopped developing, up at around $3 billion. The unit cost of production will be very high if Boeing produces only a few of these planes, as we must divide this fixed cost by a smaller number of final goods. The unit cost falls substantially, however, if Boeing produces 1,000 of these new planes. What we see then is that the average cost of each unit falls as the number of units produced rises. Firms and industries with such scale economies face a dilemma, however. They could produce efficiently and begin to export once they produce enough output to achieve the available scale economies. In an open economy, however, these firms must compete immediately against established foreign producers that have already achieved economies of scale. Consequently, a new firm will have a hard time selling its higher average cost output in the face of competition from lower cost firms. Consequently, the new firm will never reach the level of output necessary to achieve economies of scale. So, economies of scale, I think all of you know this. Maybe you probably learned this when you first bought weed the first time, right? You buy 1G, it costs more than if you bought an ounce. So I don't know if I'm allowed to say that, but that's for the people who never really liked econ. I hope I could get you into it, but even my guys making a business out there, you guys want to go and start drop shipping, buying stuff, go Alibaba, go find a producer, go buy 1 to 10 units, you're going to get a different price from 10 to 100. So they're saying, hey, if you can make an economy of scale, you have to compete with all these people foreign now. So if we protect it initially, then we can unprotect it once we're able to produce thousands of units for very cheap. Ta-da! So continuing. In such cases, a tariff might be welfare improving. By imposing a tariff, the government could effectively deliver the domestic market to the infant domestic firm. With a guaranteed market, the domestic firm could sell its early high-cost output to domestic consumers and eventually produce enough to achieve economies of scale. Once it has done so, it could then compete against foreign producers without the need for tariff protection. The tariff would then be removed. Economies of experience arise when efficient production requires specific skills that could only be acquired through production in the industry. In many industries, efficient production requires seasoned managers, skilled workers, and reliable suppliers of equipment and materials. Because these skills are lacking by definition in an infant industry, it will be costly to produce the early units of output. Over time, however, management skills improve, workers learn how to do their tasks efficiently, and reliable suppliers are found and supported. Cost of production falls as experience is gained. For example, when Airbus built its first jet, it took 340,000 person hours to assemble the fuselage. As Airbus gained experience, however, the time required to assemble the fuselage, to assemble the jets, fell rapidly. By that time, the Airbus had produced 75 aircraft. Only 85,000 person hours were required to assemble the fuselage, and eventually that number fell to 43,000 person hours. The efficient gains realized as a result of these dynamics are called moving down the learning curve. Again, however, the new firm faces a dilemma. In an unprotected market, it won't be cost competitive in the face of established foreign producers. Consequently, it will never be able to produce enough output to realize these economies of experience. As with economies of scale, a tariff can allow the infant industry to realize the cost savings available from economies of experience and achieve greater efficiency. Once it has done so, it can begin to export and the tariff can be removed. Therefore, tariffs and other forms of government intervention may sometimes improve social welfare because a disjuncture between the social and private returns from a particular industry may prevent the shift of factors out of relatively low return industries and into relatively high return industries. In other words, certain industries may offer high social returns over the long run. That is, they will provide large benefits to society as a whole, but the short run private returns, that is, profits realized by the person or firm making the investment, are likely to be negative. Consequently, factors don't move automatically in the potentially high return factors to move into this industry by raising the short run return above what it would be without a tariff. So this will explain a lot about life to you guys. And here's the funny part. I made that SoftBank joke, but you got to think about it. Wall Street learned this from the OG economies and international political economy, if you think about it. This is Econ 101, but you're seeing how this applies. This is why I always like political economy, because it is that connection of the two. But I don't know. Maybe this could be, if I was going to give you guys a model, do you agree or disagree? How do you feel about economies of experience, economies of scale? Do you believe this is true? Like, should you help out these small companies or even a big company and help it out if you believe it'll provide social welfare down the road? Think about Uber. Uber burned money forever. I remember we always call them a money burning pit. And then now look at what they're doing. Now you got to ask yourself, does that make sense? I mean, it's up to you. Would you support this or not? That's kind of a little thought exercise to go through. But moving along, the logic of the infant industry case for protection has been adopted by governments in many late industrializing countries. A late industrializing country is one that is trying to develop manufacturing industries in competition with established manufacturing industries in other countries. This term obviously describes most of the developing countries in the contemporary international economic system, but it once described many of today's advanced industrialized countries, including the United States, as they attempted to develop manufacturing industries in the face of a dominant British manufacturing power in the 19th century. Indeed, the infant industry argument was first developed by an American, Alexander Hamilton, in 1791 as an explicit policy for the development of manufacturing in the U.S. Hamilton's argument was further developed by the German political economist Friedrich List in the mid-19th century. Like Hamilton, List was primarily interested in thinking about how the German government could encourage the growth of manufacturing in the face of established British dominance. The infant industry argument continued to have an important impact on government trade policies throughout the 20th century. Many argue that Japan's post-war trade policies reflect the logic of the infant industry argument, as the Japanese government used a variety of policy instruments to encourage the development of advanced manufacturing in the face of American competitive advantages. Many developing country governments also embraced the logic of infant industry argument throughout the early post-war periods, as we will see in greater detail in Chapter 6. The policies that governments have adopted to promote the development of infant industries are known collectively as industrial policy. So before we get to the next page, think about that again. You are understanding this concept, and it's this, and it has all these phrases, and then it just boils down into, this is what we refer to as industrial policy. That is referencing the infant industry case for protection. So industrial policy can be defined as the use of broad assortment of instruments, including tax policies, subsidies, including the provision of state and credit finance, traditional protectionism, and government procurement practices in order to channel resources away from some industries and direct them towards those industries that the state wishes to promote. Emphasis on state. The use of such policies is typically based on long-term economic development objectives defined in terms of boosting economic growth, improving productivity, and enhancing international competitiveness. The specific goals that governments pursue often are determined by explicit comparisons to other countries' economic achievements. In post-war Japan, for example, the explicit goal of Japanese industrial policy was to catch up with the United States in high-tech industries. In much of the developing world, industrial policy was oriented towards creating economy structures that paralleled those of the advanced industrialized countries. I thought I had more, but I guess that's it. You guys are going to have to wait tomorrow now to get into the next section of all of it. But Chad, I really do hope there's a lot to learn out of this. I like these topics. I'm telling you, as we start moving forward, all of this stuff will apply. But like I said here in the beginning, make sure you are hanging on to some of these meanings, because the more we go into it, it will give you a recap, but a lot of this stuff is going to connect. So welcome to the world of economics, man. There's a lot of connecting things, but Chad, that is your watch list, ladies and gentlemen. Make sure you're healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, the burden is heavy. But if you don't forgive yourself, it's even more heavy. Lighten it up, baby. Be at peace. Make moves now. The second best time was today, baby. Oh, my God. So, Chad, I love you. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the morning. And horn.